Hey, welcome to Financial Statements, a snapshot into your business. We have our presenter today, Michael Sandman. He is one of our SCORE Boston mentors. And we also have with us today Eastern Bank. And we're very thankful to them for sponsoring this presentation. This is definitely a very important topic for small businesses. I know Eastern Bank agreed, and that's why they're assisting us today. This presentation is full of tons of great information, and we will be sharing that information in a follow-up email with you. So please don't worry if there's something you miss along the way. We will make sure you get those blanks filled in. I just want to start with a brief introduction to SCORE. I want to make sure that you're taking advantage of all the things that we offer. Our goals as an organization is to share small business information with you. We do that in a couple of different ways. One is through our website, score.org. You're going to find articles, blogs, recordings, just tons of great information. There's templates to download, financial templates, marketing templates, business plan templates. Lots of great information. The other way we share information is through our workshops. Our workshops are mostly online. There are some in person as well. Those are advertised through our newsletter, through social media, and through our website as well. So if you're hooked up to all those three different things, you won't miss any of the great presentations we have coming up. So the most important thing that SCORE does, however, is mentoring. And our mentors are volunteers, and they simply want to give back to the community. They come to SCORE with a wide range of experiences and knowledge to share with you. And who are we working with? We're working with the whole gamut. So it's from those that is small business right for me, those that are in the planning phase, those that are just starting out, growing their businesses and getting ready to exit that business. So if you're in any point on that pathway, we're there to help you keep moving forward. If you've never had a mentor before, a mentoring session or a first mentoring session will be probably in the 45-minute range. They want to learn about you, what your goals are, what your challenges are, and they're going to work with you to formulate a plan so that you can be successful. Oftentimes, after that primary meeting with your mentor, they could invite other mentors in to assist as your needs change, because we want to make sure that you get what you need. Now, how do you get that mentor? There are actually several different ways on the website, score.org. I think the easiest one is just to put in your zip code. That matches you to the chapter that's nearest you. And then we're going to ask you a couple quick questions, and we use that information to match a mentor's skills to your request so that we make sure you're getting the questions answered that you need. So a couple little pointers about today. I do prefer to use Q&A. It's on your Zoom bar. That just allows me to keep track of questions and not lose any, because sometimes chat can have a lot of things going on, and I don't want to miss anything. So if you have a question for our presenter or the bank, we will get to those questions when we can. Most of them may be held to the end, but we'll see how those go. So if you can put those into Q&A. Now, anything else can go into chat. That's completely fine. We are recording. And as I mentioned at the beginning, we will send a follow-up email. I will send that recording link. You can also find it on the score.org/Boston website. You can see from the graphic there in the local workshops pull down on the blue bar. So I'm going to go ahead and we're going to get started. I do want to introduce Tracy Westgate from Eastern Bank. She would like to say a few words before we get going.
Good afternoon, everyone. Again, I'm Tracy Westgate from Eastern Bank. So happy to be here with you. I'm another resource for you. I'll put my information in the chat, and I know it's going to be in the email as well, but I'm here to answer any questions. A little bit about Eastern Bank. We are the #1 small business lender in Massachusetts for 16 years running. So we are very happy to be partnering with SCORE, and I'm here, like I said, as another resource to help guide. Any questions you have, please reach out, and I'd be happy to answer everything for you, and happy to be here. Thank you.
Thank you, Tracy. All right, Michael, it's all yours.
Okay, thanks. So, good afternoon. Thanks for joining us. I want to add to what Tracy said by saying that Eastern is my bank, and I've been they acquired a bank that or merged with a bank that I had been with for many years, and I've been very impressed with Eastern's ability to move quickly and service customers. So if you have banking needs, we always tell people to try to work with a local rather than one of the big national bank organizations. So take a look at what their offerings are. Um, Okay, so today's agenda, we're going to go through financial statements, balance sheet, profit and loss statement, um, a cash flow, and then we're going to take a look at startup costs and a cash projection. And sometimes people look at the statements that they get, whether they use QuickBooks or they have an accountant who provides them with some other form of statement, and they understand the profit and loss statement a bit, but the other statements are a mystery. You know, what does this stuff all mean? The statements are very useful, and they are a snapshot, a picture of your business that you can use. And if you go to a lender will typically ask to see them because the statements, these other statements that sometimes are a bit mysterious, tell a story about the business that can be very helpful. So we will look at the three financial statements first of all. The balance sheet, which is over here on the left, that shows you assets, liabilities, and equity. The profit and loss statement, it tells you how much money the business is generating in profit. And finally, the cash flow, which tells you where cash has come from to operate the business and where it's been used. And so we'll explode each one of these things into a much larger format so that you get a good sense of how to use them, what they mean, what other people will use them for. And finally, at the very end, we're going to look at a cash flow projection, and this looks like a horrendous box of numbers. But I promise you, that by the end, you'll understand what it's for, and I hope that you'll make use of this really great tool. A cash flow projection can be enormously helpful for you. It can be enormously helpful again, for if you have a lender or you're looking for one. So, it's also very useful, as we'll see, for starting a business. So we'll go through the three main statements and then we'll look at that cash flow projection. As you're going along, if you have questions about the material, as Tracy says, please use the Q&A to ask questions. You're welcome to chat with each other in the chat window, but for questions, we'd like you to use the Q&A. And if there's something that Tracy thinks should be answered right then and there, she'll let me know that, and otherwise we'll answer the questions at the end. Okay, a balance sheet, sometimes it's also called a position statement, is perhaps the most mysterious of all of these things that come out. What does this thing mean? Well, so what it tells you is what you own, what you owe, and what you owe not just to a lender, but what you owe to vendors, perhaps to employees, to family members, perhaps, and what your equity is in the business, what's left that belongs to you. So it's the net, the leftover part that is your equity. And so equity equals assets, what you own, minus liabilities, what you owe. And that tells you what something about actually the value of the business in an ongoing sense. And if you were ever involved in either buying or selling a small business, the owner's equity is an important number to understand. And so the balance sheet is actually an important number to understand as you're managing your business. And another thing it tells you is whether you have enough capital in the business. And we'll take a look at how that works, what that seems to, how that falls out of the balance sheet. It tells other people, bank, a landlord, whether the business is solvent. That is, whether you have more assets than liabilities. And is it safe to be owed money by this business? And even if you don't have a loan with a bank or another lender, If you have a landlord, then the landlord is very concerned about that. They want to make sure that they're going to get their rent. So a balance sheet is very typically used by outside parties when they take a look at the state of your business. If you're just starting up and you're just thinking about starting a business, you won't see a balance sheet at the beginning. But as we get into looking at startup costs toward the end of this presentation, you'll see how a balance sheet ultimately gets put together. So here is a balance sheet for Joe's Pizza Palace. Joe's Pizza Palace was in, well, this is 2023, but it could just as well be 2024. You can see what Joe has in cash in the bank. He has a pretty good sized bank account, almost $35,000. He's got food supplies and beverages on hand. And so his total current assets, the assets that he can turn into cash in one way or another, if they're not already cash within a year, amount to $40,673. And he's got fixed assets. These are things that he can't so easily turn into cash, but they have value nonetheless, and they belong to the business, so it's what he owns. It's part of what he owns. So he put $12,000 into leasehold improvements. He put counters in, or he put an oven in, or something of that sort, and furniture and fixtures and kitchen equipment and so forth. That's money that he spent uh, to invest in the business probably when he first got it started. Those things, they're called fixed assets because they typically last for longer than a year. And the other thing about fixed assets is they're not easily turned into liquid. They're not easily turned into cash. And he's got some technology that he's invested in. And then he's got some depreciation. That is, recognizing that those assets slowly decline in value. Accountants say, okay, you have to take a certain amount of that value and set it aside every year into an account called depreciation. And we're going to get into depreciation a little bit further. But that number reduces the value of his assets by $9,350. And so his fixed assets after depreciation are $28,050, and his total assets are $68,723. It's his current assets, cash, food supplies, beverages, things that can be turned into cash fairly quickly, and plus his fixed assets, the things that he owns that he uses to run the business, but they're not liquid. They're called fixed because they're sitting there in the building. On the other side, well, what does Joe owe? So he's got some accounts payable. He owes some vendors for some of his food supplies. He has wages and taxes payable. So he's pretty much up to date on that, but he may have some taxes that are due in the current week or next week. So his current liability is very low, only $1,700. But he's got a loan from Aunt Betty that he used to start the business. And Aunt Betty gave him $30,000 to start, and he hasn't reduced that at any point, or at least this is what's left of it if he has reduced it. So he's got total liabilities of $31,700, and he put $5,000 worth of business in, and over time he has retained earnings. He has kept profit in the business that he's earned instead of taking it out for himself or his family of $32,000. So he's got a total owner's equity of $68,000 worth of assets minus $31,000 of liabilities equals $37,023 of equity. And if you add those two numbers back up, liabilities and equity equals assets. So again, he's got assets. That's what he owns. He's got liabilities. That's what he owes. And here's what's left over, $37,000. So if you said to Joe, what's the value of your business? There are a couple of ways of looking at it. One is, well, what's the stream of profit that I'm getting out of it? What's that worth? Another is, well, what are my fixed assets worth if I wanted to sell them? And a third way is, what's in here for owner's equity? How much money have we got invested in the business that belongs to us, that's net after any liabilities that we owe?
Mike, can we clarify one point real quick before we move
Sure.
forward? Can you explain the difference between cost of goods sold and variable expenses?
Um, well, it's a bit of apples and oranges, really. So we're talking about profitability of the P&L when we talk about cost of goods sold and variable expenses. Cost of goods sold is what it costs you to produce the product before any overhead, before any of the rent or telephone, web services, insurance, any of those things, and before any of the labor costs that go into the cost of goods sold. But uh, variable expenses are expenses that go up and down depending on the amount of business that you're doing. So in Joe's case, food supplies and beverages are variable expenses because that's what he has to, and labor, by the way, um, because that's what he uses up as he's providing pizza. And his fixed expenses would be his rent, for example, and other things that he has to pay, even if nobody buys a pizza that week or that month. So we'll get into that when we get into the P&L.
Thank you.
Okay, a few words about depreciation. Remember, I said that assets, fixed assets, slowly decline in value, and some assets they have a value that lasts longer than a year. Furniture and fixtures in a store or a shop, technology, a computer, software that you own, point of sale equipment, leasehold improvements, things that stay in the building like new lighting or flooring, or uh, in the case of a pizza place or a restaurant or something of that sort, the owner might have invested in a ventilation system for the kitchen. And so it varies. Sometimes businesses will have vehicles, trucks, or vans for delivery or something of that sort. There are lots of things that can last longer than a year that are used in the business on an ongoing basis. But they do decline in value over time, as we've said. They wear out, they break, they need to be replaced. They may be replaced by something different, something better. And depreciation accounts for the annual drop in value of those assets. And it's an approximation. It is, I like to say, it's a scientific wild ass guess. There are certain rules for how you depreciate different kinds of assets in the accounting profession, and they reflect back the tax rules for depreciation. But still, it's an approximation. It's an accounting fiction of sorts, but it's still real because there really is a slow drop in the value of those assets. It's therefore an expense each year that reduces your profit, but it doesn't take any cash out of your pocket until you have to replace the asset. So let's think about that a second. It reduces profit, but it doesn't reduce cash. Well, you've already spent money to acquire the asset. So that money's gone. It's in the asset. Um, the asset is declining in value, but it's not costing you any money while it's doing that. You're setting aside some part of your profits in an account called depreciation, but it's a non-cash account. It doesn't take any money out of your pocket. Out of your pocket. And at some point, you will have to replace that asset, presumably. And there are tax guidelines and accounting guidelines for how quickly to depreciate different kinds of assets. But the key thing to remember is it's an expense, it reduces profit, but it's a non-cash expense. So when we get into looking at the uses and sources of cash, where cash comes from in the business, you'll see that depreciation is actually a source of cash. Okay. Um, what does somebody look like? Look for in a balance sheet? They look for some financial ratios. So here are three very typical ratios to look at. The current ratio, or the working capital ratio, it's current assets divided by current liabilities, and that's ideally above 1 to 1. And Joe has very little in the way of current liabilities, doesn't owe very much money to anybody, and he's got a pretty good chunk of money in the bank and some supplies. So he's got a really strong current ratio. The quick ratio is current assets minus inventory divided by current liabilities, because inventory sometimes can't be turned into cash very quickly. And again, the lender is looking for a 1-to-1 ratio or better, and Joe's is very high. Although next year he owes a significant amount of money to Aunt Betty, and that will change his quick ratio next year. And finally, we have the debt to equity ratio, and that's total liabilities divided by shareholder equity. And you look for an outsider will look for a ratio of less than 1.2 to 2, something in that range. And he's under that. He's at 8.6. So let's go back and take a look at that for a second. Total liabilities divided by shareholder equity. So here's total liabilities, 31,700, and his equity is greater than uh, liabilities and 37,000. So that's why he has a ratio of less than 1. If those numbers were reversed, if he had borrowed $60,000 from Aunt Betty and he had $61,700 worth of liabilities, his ratio wouldn't look quite so good. So retaining money in the business from the profits that are generated is a very helpful thing in terms of giving you financial stability, because you want to be able to more than cover your liabilities with your equity. Okay. Um, so that's the balance sheet, and what lenders look for is indications that you will ultimately be able to pay them back. That's what the most important thing is to a lender. They certainly want that a rate of return. They want interest on their loan, but they're very, very interested in making sure that you can pay them back. And these ratios are indicators of that ability. Okay, so take a look at your own current assets divided by current liabilities, the quick ratio, the debt to equity. Calculate that for your own business and think about what that tells you about how a lender, whether it's a bank or a family member or a friend, will view your business. What could you do to improve that position? One of the things you can do is try to pay down debt. And so obviously that's going to take some cash, but nonetheless, if you look at how the impact of paying down debt with some of the cash that you have that you don't need right now in the business, that can help improve those ratios. Okay, now let's look at the profit and loss statement, and I think this is the thing that most people are the most familiar with. And so what do you think of when you hear the bottom line? Well, the bottom line is how much money you've got after you've paid all the expenses of the business. So what the P&L tells you is how much money came into the business from customers, that's the revenue or the sales, how much went out to pay expenses, that's expenses for you and your employees and your suppliers, and the other expenses that you have, web services, legal services, accounting, whatever they are, interest, and what's left at the end of the month or the end of the quarter and in the end of the year is your profit, your net profit. And what it tells other people is how likely you are to be able to pay for your expenses in the future, whether you're a good risk. So if your business is generating some profit at the end of the year, that's great. That means that you're going to be adding a little bit probably to your cash, but in any case, you're able to cover your expenses, more than cover your expenses, and that's very, very reassuring to anybody looking at it from the outside, whether, again, it's a lender or a vendor or a landlord. If you're not able to do that, then it's difficult to find somebody who's going to be confident that it's okay to do business with you in a way that puts them at any sort of risk. Okay, so let's look at Joe's Pizza Palace and his profit and loss statement. So he has three kinds of business. Eat it here. Pizza people come in, they sit down at the table, they have a pizza, maybe they have something to drink, and then he has takeout, and finally delivery. And so his total revenue is $486,000. And it's really useful if you have different classes of business to keep that information categorized separately so you understand something about where your revenue is coming from. And you can actually do if you're you can actually do a profit and loss statement for each segment of that business, each line item of that business, within some reason to give a sense of which segment of the business is best for you to try to expand and which one you may not want to expand. Okay, so his total revenue is 486,000. Here's his labor, including his labor, 199,200. And it's really important, whether you're thinking about starting a business or running one, to remember that you have a cost. And if you're thinking about starting a business, you really should. It's very, very important to include the cost of your own labor in the projections that you put together for how that business is going to work. Because I mean, otherwise, you have nothing to live on. You won't be able to take money out of it to live on. So your wages are as important as anybody else's. Joe has payroll taxes to pay, and he has some health insurance, so that's his total labor cost, 235. And food and supplies, this is what it costs him uh, to make his pizza, to bring in beverages, to pizza boxes, delivery fees. That's his total food and related supplies, 166,440. That looking over the rest of the P&L, he's paying $24,000 for rent for the year. That's his phone and utilities cost. His liability insurance of 21,000. Sorry, $2,160. And so those are his occupancy costs, the cost of being in his place of business. If you're running a business that's all virtual out of the home, perhaps out of your home or something of that sort, your occupancy cost is probably very, very low. It may be um, substantially below what Joe's is, but there is some cost because you are paying for utilities and you should be attributing some of the costs of the space you're occupying to the business. He's got administrative costs and depreciation. So he's got internet hosting costs. He's got some legal and accounting fees, and that's his depreciation for the year. That's the amount that his assets, his fixed assets, declined in value over the year as they began to wear out. And so his total administrative and depreciation costs are $8,900, and his total operating costs is $441,724. He also owes interest to Aunt Betty on the $30,000 that she lent to him. That's not an operating cost. It's something that comes in afterwards, but it's cash going out the door, and it reduces his profit. So all of his costs together are 442,924, and his revenue back up here was 486. So he's got $43,000 in profit before income taxes, and then he's paying 12,000, almost $13,000 in income taxes. So his net profit is 30,153. So I think most of us are familiar enough with the profit and loss statement so that this one looks fairly transparent. It's fairly easy to see. It's the revenue that comes in, the money that goes out. Each one, revenue is categorized by the type of business, the segment of business that you're doing, or the category, and the expenses are also categorized by what they are: labor, supplies, occupancy, administration costs, and depreciation, and the below the line costs such as interest. Uh, and it's really important to understand how those, those categories do need to be kept separately because the information helps you understand where your money is going. If you lump them all together, if you just said, well, you had a P&L that said $486,000 worth of revenue and 442,924 of costs, that's great, but where are those costs? How can I save some money? And if I increase the size of my business, what costs will go up? I have no idea. Now, let's go back to the question that was asked earlier about variable versus fixed costs. So Clearly, the food and related supplies are all variable costs because they relate directly to the pizza that he's selling. The labor cost, most of that is also variable. If Joe wasn't selling any pizza at all and he was trying to take some money out of the business, well, he wouldn't have any revenue at all coming in. So he wouldn't have employees, but he'd actually still have himself to try to pay out of his bank account. Um, and he'd still have a little bit of payroll taxes and health insurance, but that number would be much lower. Just the same, there's a substantial amount of that that is a variable cost. And substantial amount, Joe, would be a fixed cost. Okay, his occupancy costs are fixed. Again, whether he's selling pizza or not, he's going to pay the rent. And that's also true of his administration and depreciation costs. So when you think about variable costs are the stuff that's directly related to delivering the product or the service that you're providing. And it includes labor, and particularly if it's a service business, it includes labor. Uh, and everything else, all these other costs, occupancy and administration, depreciation, all of those individual items under there, excuse me, are um, are fixed. They go on no matter how much revenue you've got in the business. So think about that a second. That means that if you increase your revenue, your your eat it here business goes up. Joe does something to attract more customers to sit in the pizza parlor, and or he gets more takeout business or something of that sort. If that number goes up, his labor will go up a bit because there's some fixed cost in his, sorry, some variable cost in his labor. He may have to extend the hours of his uh, assistants, or he may have to add a person, something of that sort. His food and related supplies will go up in direct ratio to the new business that comes in, but his occupancy cost doesn't change, and his administrative costs don't change. So there's an advantage to Joe if he can grow that revenue line, the amount of sales that he has, as long as it doesn't add something, as long as he doesn't have to go out and rent more space or something of that sort. But even there, as long as he can add enough revenue to more than cover the cost of additional fixed costs that he may decide that he needs to take on, um, he'll be doing better. So I hope that clarifies fixed and variable and the effect that increases or decreases in revenue will have on the profitability. A decrease in revenue obviously would reduce the amount of profit that he's got. It would reduce his labor somewhat. It would reduce food and supplies, but it doesn't reduce his other costs, his fixed costs. So it's really important for him to maintain, and if he possibly can, expand that revenue. Okay, so what do we learn from Joe's P&L? Is the business making a reasonable profit? Yeah, he is. He's making like about 7% after taxes. Um, what expenses would change if the business slowed down by 10% or increased by 10%? Well, you could calculate that. Let's go back and take a quick look. If his business increased by 10%, he'd have another 48, almost $49,000 worth of business. Um, his labor costs and his food and related supplies would uh, would account for a good chunk of that. 235, 166, another 30 or so thousand dollars. But no, yeah, that's about right. But his administrative and and other costs would not change. So his profit would go up a reasonable amount. And the same thing wouldn't go up by 10%, but it would go up by some percentage. And similarly, if his business went down, his profit would go down by a significant amount. Okay. For your own business, if you're already in business, well, are you profitable? It's an important question, and I'm sure you know the answer to that. What are your fixed cost versus variable costs? So what kinds of costs should you be thinking about trying to control very, very carefully? Well, really all of them, but fixed costs in particular, you want to be very careful about adding fixed costs. How could you grow the business? How would you add enough revenue so that you don't need to add any fixed costs or very much of it? And what new resources would you need? Do you need to hire new people? Do you need um, space for your equipment? Do you need some capital, some cash to buy new equipment? If you're already there, those are things that you need to think about if you're trying to grow it. If you're thinking about starting up a business, or if you are just starting up, you have to think about how much revenue you're going to have when you first start, because you're not going to go from zero to full revenue right away. It takes months, uh, 3 months, 6 months, sometimes longer, to get up the curve to start. You start off a little bit of business, and then eventually you reach hopefully a high enough level and at a fairly excuse me, steady state. And we'll look at that when we look at cash flow projection for a start for a startup. And you have to think about what your startup costs will be, and we'll look at all of that stuff. And once you start, which of your expenses will be fixed and what will be variable, and how long it'll take you to make a profit. And I promise that at the end of this, we'll take a look at that cash flow projection so you get a sense of how to do that and some of the things, the nuances that are important in understanding how to put numbers into that projection. Okay, cash flow. Uses and sources. What do you think of when you hear cash flow? Well, you should be thinking of where does the money come from and where does it go? So where cash came from, where it was used, whether you need to think about finding additional sources of cash or capital, and what it tells somebody else if they're looking at a cash flow statement. Are you able to finance, to pay for the ongoing operations of the business without building up debt? That is, are you are you able to bring in enough cash to cover all of your expenses without having to go outside for additional money? Are you likely to have the cash that you need to grow the business? Because you may be able to operate just with a bare margin and keep it going, but if you want to expand or to grow, you may need cash to invest in advertising and more space in something. If you need more capital, will your cash flow support paying the interest and paying back the principal? So we're going to look at all of that stuff in the cash flow and the uses and sources statement. Okay, this is a cash uses and sources or cash flow statement. Um, at the beginning of the year, Joe had $53,000, $5,300, I beg your pardon, in cash. Cash came in. Cash came in from his revenue when people came in and bought pizzas. He paid out $235,204 to his employees and $166,400 to his suppliers, and that was his occupancy cost and so forth. And by the way, all of those numbers can be found on the P&L. So let's just go back and take a look. 235,204. Let's go back and look at his P&L. There it is, 235,204. So that is one of the uses of his cash, his labor. That's on that cash flow statement. That the numbers come directly from the P&L on this side of things, this side of the statement. And so he got in $446,000 worth of cash because he paid some money out, right? This is what came in. This is his. These are his expenses. That's his net cash. That's the total amount of cash left over after his expenses. Started with $5,300, so he built up about $34,000 in cash. So what did he do with that money? Where did it go? Well, he used some of it to buy a purchase and sale system, $3,500. So that's an investment in the business. That's something that's going to last longer than a year, and it will gradually decline in value. So he'll be writing depreciation on that. But that's his investment. He repaid $5,000 to Aunt Betty. He paid interest of $1,200. So he used up $6,200 of his cash in financing activities. So altogether, he had an increase of $29,373 in cash, and his ending cash balance is the starting cash balance plus the ending cash balance, 34,673. Okay, that all ties together. The numbers all add up. But what does it mean? So some things to look for. What are the main sources of Joe's cash? Well, pizza. That's what he sells. And what are the main uses? They're expenses directly connected with making and selling the pizza. Are there any concerns, like an increase in what Joe owes to suppliers? In other words, if we had a line back here um, that he got, he managed to build up his accounts payable by not paying his suppliers, and that was a source of his cash. That wouldn't be a good thing. That's not a good thing to, generally speaking, to have happen. Um, so, are there any concerns in what he owes to suppliers? Does he have enough cash to operate the business? Well, pretty clearly, yes. In fact, you can expect that either Joe is going to take some of that profit and give himself a bonus at the end of the year, or maybe he's going to open a new pizza parlor, and we'll consider how that might work. And does he have enough to expand, or would he need more capital? So let's take a look at that, and we'll end up with the cash flow projection that we've been talking about. Okay, if you're already in business, it's really useful to create a cash flow statement. Again, this is a bit like the balance sheet. In fact, it's probably even more so. People get this if they're using QuickBooks or something like that, or if if they have an accountant who's providing with the statement, but they don't tend to understand what it is. So if you're already in business, look at that statement. Think about what the main sources of cash are. Think about where it goes. If you want to expand, will your cash flow be enough? Will you need more capital? Thinking about the balance sheet, the P&L, and the cash flow into consideration, if you needed more capital, is a bank or a nonprofit lender likely to give you a loan? Are they going to be looking at those statements and say, yeah, this is a good risk, we'll be able to get our money back? If you're thinking about starting a business, once you get started, where will your cash come from? And what are the major expenses going to be? How soon do you think the business will be able to cover the expenses? That is, have at least as much cash coming in from sales as going out for expenses. And taking that expected P&L and cash flow into account, if you were lending money, would you give yourself a loan? That's a really interesting question to ask yourself if you're going to try to start a business. If you were going to be, if you were asked to finance that business, do you think it would be a really good idea based on doing some homework, doing some projections of what you think the revenue and expenses of that business are going to be? Okay, so let's talk about startup costs, because Joe's going to start another Pizza Palace here, Pizza Palace number 2. But his startup costs would be very similar to somebody starting from scratch, brand new business. So what can we tell from the balance sheet about how much it cost Joe to start his business? His assets are up here. You remember the balance sheet. And these are his fixed assets. So these are the things that he put money into in order to get started, plus some other things. He probably paid his landlord a couple of months of rent in advance, and probably spent some time himself uh, working in the business to get it going, and get the place organized so he could open the doors. But this gives you a sense of over here, the fixed asset side, what it cost Joe to start his business, and where the money came from. He had $5,000 to begin with, but he had Aunt Betty give him $30,000. And he didn't have any retained earnings because he was just starting. So that was zero. Okay, so those are some of the things you can see from the balance sheet of a typical business where it cost the owner to start his business. If you were trying to figure out for yourself, well, what are my expenses going to be? There are a couple of really good resources. One is talk to a SCORE mentor, because SCORE mentors have started all sorts of businesses. We have about 80 people in the Boston office, And across the country, we had literally 10,000 SCORE mentors who have experience very often in starting a business and you can find a mentor who has started a business that's similar to yours and give you some help with that. You can go and talk with a bank loan officer, and bank loan officers have access to information about what kinds of businesses take what kinds of capital. And also, you can go and do some research at the Boston Public Library. In the lower level of the new part of the Boston Public Library is something called the Kirstein Business Library, and there are reference librarians there who can help you find information about the business expenses of different kinds of businesses. So there are some pretty good resources. There are trade associations that you can find if you're looking for information of that sort. So if you do your homework, you'll get a pretty good sense of what it takes to start. Okay, so what does Joe need to start his second pizza palace, Palace 2? So he's got let's say he's got a starting cash balance of $60,000, and he's got all of these expenses to start with, $39,200. Website and corporation fees, a rent deposit, a restaurant build out, kitchen equipment. Some of these things come right off of the balance sheet, right? Because he had these categories, they're worth a little bit less than what he paid for them because they've declined in value a little bit over time. But that's what he had to put into them to get them going in the first place. So he's got $39,200 that's going to come out of his pocket to start. And now he's going to do a cash flow projection. So what does it tell you? Where you are now, how much cash can you generate during the next year? Is that enough to run the business or to expand it? Can I get through the year, or do I need to bring more money in? Will I be able to cover my costs of borrowing? And what it tells somebody else is, has the business owner made realistic revenue projections? So when you're doing that homework and you're thinking about, well, what are my expenses? You should also think about how quickly can I build up revenue? Because I'm going to need to show that to somebody else if they're going to help provide me with some money. And by the way, I have to justify, if I'm going to finance it myself entirely, I have to justify to myself lending money to me. Okay, so I should be realistic about these projections. How long will it take? Weeks, months to start generating cash? Will they have enough capital at the beginning to finance the business when it's not generating enough cash to cover expenses? Because that's what happens to most startup businesses. Initially, you invest money and you have some expenses that exceed the amount of revenue that comes in. That's, you didn't have any revenue when you first started, and you have some expenses to get started. Very clearly, you need some free cash to get going. Okay, so this is a big ugly box of numbers, but we're going to try and get through it. So this is what Joe's going to have in startup costs, $64,000 in cash. And then he's got $39,200 worth of startup costs, and it's going to take him a month to get situated in his new Pizza Palace #2, and he's not going to have any revenue. Can't open the doors. He's not finished yet. He hasn't got the certificate from the city health department or whatever it is that he needs from the common victualer's license from the Board of Selectmen or something of that sort. So he's got no revenue at all coming in, but he's got to pay, including himself and a part-time manager. And he's got a little bit of payroll taxes and some health insurance for them. And he's got liability insurance, and he's still paying interest to Aunt Betty on his original loan. So he's got $7,300 worth of operating expenses, and not a nickel has come in for revenue. And so his total costs, startup costs, and all of his operating costs come up to $46,000, and that makes a big hole in his cash. It brings it all the way down to $18,000. And the next month finally gets going, and he's got $7,500 worth of Eat It Here and some takeout business, delivery, but $12,500 worth of pizza. But his operating costs have gone up. He's got wages, he's got payroll taxes to pay, he's got food supplies, beverage boxes, delivery fees, and so forth. But he's also got rent and all that sort of thing, on Betty and so forth. Those are the fixed expenses that he's got, even if money doesn't come in. Remember that. And so all of his costs are $19,855, and that comes off of that. Um, uh, he's got revenue of 12,500, 19,500, and 19,855 of expenses. You put those two numbers together, he's used up another chunk of money, about $7,000. So his cash balance has gone down again. And that's going to keep happening until April, when finally he gets the revenue going to in May to more than cover his outflow. So he's got a gradual increase from 12,500, 18,500, 23,000, 34, 46. And this isn't about the 46, is about the level that he's got in his first Pizza Palace. So that's what he's sort of aiming for. And that's the projection that he does. And by the way, July is a great month for pizza because people have parties and so forth. And December, not so much, because do you have pizza for Christmas? I don't know. Probably not. And takeout business goes down, delivery business actually goes up because maybe for office parties goes up. Anyway, those are the projections that he's made based on the seasonality of the business. That's another aspect that you have to think about. So this is his projection for his Pizza Palace #2. It would go perfectly well if it was Pizza Palace #1, because all of the same things would apply here, except perhaps for, well, if he borrowed money from Aunt Betty, that would still apply, the interest cost. So again, when you're doing that projection for a startup or an expansion, it takes time to get some revenue from the investment that you've made. Be realistic about the amount of time, the slow uptake that you'll get from your customers, and it varies business by business. It depends on the kind of business that you're operating. A restaurant may get off the ground much more quickly than some other kinds of business, and perhaps more slowly than even other types. So, um, what are or were the startup costs? Your expenses, your startup costs are permits, licenses, fees, things you only have to pay once. Technology, getting the location ready, deposits, besides rent perhaps, sometimes utility will ask for a deposit, supplies or inventory to get going, labor for setup, anything else you need before you open the doors. They are one-time expenses typically, and you have to have paid for them in order to get going at all. And then you have ongoing expenses, rent, labor, payroll taxes, professional services, accountant, attorney, whatever, supplies, inventory, marketing costs. We haven't talked very much about that. Other kinds of expenses. Those are the things that are ongoing expenses. So if you go back and look at the cash flow, the operating expenses are up here, and the fixed expenses are down here. The rent is $2,000 constant across the period. He's paid out in advance some money to his landlord for deposit, so he's not paying for January, but he's paying for all the other months. And he's got internet hosting costs and legal and accounting costs and so forth. Those are the things that are his fixed expenses um, that uh, that you have to remember are over here, along with the labor and the food and so forth that he's putting into the product. But he's got these startup costs that, going back here, are all buried up here in this big number, $39,000 startup costs. And we got that number because he knows that this is what he has to put into the business. So these things are all linked together. And if you can understand your startup costs, you can build a good cash flow projection. You really can't if you don't have a good understanding of startup costs. There are good resources for finding startup costs, what they're likely to be, and put them all together in that great big ugly box of numbers. And we're going to send you, Teresa. We're going to send this out, right? The spreadsheets out.
Correct.
Yeah. Okay. So you'll get this, and you can work work this for yourselves. Okay, so accounting help. There are a couple of products, QuickBooks and Wave, that have good apps that are relatively straightforward, although you may need an accountant to help you set them up. Um, get a part-time bookkeeper. That can be an enormous relief for somebody running a small business or starting a small business. There are payroll payroll services, Paychecks, ADP. There are others that will take over your payroll, pay your employees, pay your taxes to the state and federal government, and all you have to do is have the cash in the bank to cover that, and you don't have to do the paperwork, and that's immensely valuable. It's like the bookkeeper, and an accountant to help you figure out what your tax liability is going to be, and help you put all this stuff together, all these statements together, and interpret them for you if if you have some questions yourself. And again, you get technical assistance from SCORE. How do I do this? How do I do that? What do I need to think about? You can get that from us. Okay, that's the presentation for today. And any questions? What have we got in the Q&A? I actually haven't looked.
Yeah, I do have some questions for you. I also have one for Tracy, as well.
Good.
I'll give you one mic and then we'll hit Tracy here in a second.
Sure.
Is it okay if your business is set up to take an owner's draw instead of a salary?
Oh, sure. Yeah, absolutely. Yeah, as long as you remember that it's a cost and you're going to have to pay it, because other than that, otherwise you can't pay for groceries.
Right.
But yes, you can do that.
Okay. Tracy, can I ask you, we have a question for you. Um, what are these, like if you're looking to come to the bank for a loan or line of credit, which of these reports are important? Are they all important? Do they matter?
They do, yes. So, we will need financials for any sort of loan or line of credit. Tax returns, your year-to-date profit and loss and balance sheet. Um, so we will need to make sure that the business is profitable and that it can pay back a loan. So all of these are important. Yes.
Thank you.
Mhm.
Okay, Mike,
That's a good thing you said that, Tracy. Otherwise, what are we doing here?
I hear of EBIT, which is the earnings before interest and taxes,
Yep,
and an EBITDA, which is earnings before interest, taxes, depreciation, and amortization.
right.
Um, can you explain what they mean? Or, well, we already explained what they mean, but where they show up in the
Sure.
financial process?
Let's go back here to the P&L. Sorry. Let's go, P&L, where is it? Okay. So uh, here is operating costs. If you left out the $1,200 of interest, um, you would say that this business had $486,000 worth of revenue, $441,000 worth of operating costs. That would be the remainder. What is that? About $45,000 is 44,276 actually. That remainder is the earning before interest, taxes, and depreciation and amortization. That's what the business has produced before any of these sort of ancillary expenses come along.
Okay.
Sorry, I beg your pardon. I need to take depreciation out of it as well. So it would be there'd be another $4,600 worth of income before before uh, interest, depreciation, amortization, and so forth.
Okay. Another question for Tracy. Does
Yep,
Eastern Bank finance startups?
We do, yes. We will partner with the SBA for that. We will need 3 years of projections. First year will be broken down monthly. The subsequent 2 years would be quarterly. And SCORE has a great template to help with the financials that we're requesting. We need to have a detailed business plan, but yes, we do startups.
Okay.
so I would say, I just want to say that Eastern is somewhat unusual in that. That's one of the reasons that they're, I think, still the largest you are the largest lender of SBA guaranteed loans.
Correct.
And it's a great bank to go to for a startup, but you have this big box of numbers that you have to come up with. And we have a separate workshop in which we go through basically we spend an hour going through constructing this sort of thing. So there are resources we can help you with if you're in that situation.
Does Eastern Bank have loans for the purchase and rehab of properties by flippers?
Depends on the situation. If we're looking to, we want a stabilized property, meaning that we would need to have leases and rent. So the property will have to cash flow in order for the loan. And sometimes it's a little bit difficult for someone who's going to be doing flipping a house because they don't have the leases there. But there are some other workarounds that we can do outside of the box lending. So conversation usually will happen as to what options we can go with.
Okay, great. Mike, how can we forecast production based on a revenue increase?
I'm not sure I understand the question. Give me that one more time.
Yeah, how can we forecast production based on revenue increases?
Well, if you're projecting that your revenue is going to increase, you go back and look at your costs of producing that revenue, the labor, the supplies, the whatever that you're using to put into the product or the labor that's going into the service. And you should be able to draw a reasonable conclusion as to how much it's going to cost to make that additional product. So let's just go back and look at a P&L back here. Balance sheet, sorry, here's a P&L. Okay, so there's a ratio here, right? $486,000 and his labor cost is 235, and some of that is fixed labor because that's him. But let's just assume for the moment that all of it is variable. It's all dependent on, because I suppose Joe would go home and do something else if he had no business coming in the door. So more or less, there's about, well, let's do more rather than less. Hang on just one second here. Gonna get a calculator up. Okay, so um, 2.5 486 is more or less 48%. So if he projects that he's going to have another $10,000 worth of business, he's going to spend about $4,800 of that on labor, more or less. And similarly, you run the same little calculation, 166,400 divided by 486. So let's do that. About 34% of it will go for supplies. So 48%, 34%, more or less, he's got about 83% operating costs for production costs for that new product, that new $10,000 worth of a pizza. But of course, that means that he's going to have, since his fixed costs don't change, he's going to have profit, pretty substantial profit, about 12% on the additional sales.
Okay. All right.
I hope that answers the question. If the person wants to come back with another question, I'd be happy to make sure that that's understood.
Yeah, so we definitely have hit the end of our presentation. I do have one more question for Eastern Bank. And there was another question that was submitted that's a little bit more involved. And I really strongly encourage you to meet with a SCORE mentor and they can go through your specific situation with you. We do have several or a handful of financial mentors. So last question, does Eastern Bank have any special services for veterans who are looking to finance a startup?
We do actually, yes. So depending on what percentage the veteran owner is, we can look at some other things. As far as startups though, usually they require 1 year in business for the special program that we offer for veterans. Startups will pretty much you're gonna have 20% interest in the startup for that. So yes and no to answer that question.
Okay, great. And again, we'll be sending up a follow-up email. It's going to have the recording link. It's going to have the templates for these forms. It's going to have contact information for Eastern Bank. It's going to have contact information on getting a SCORE mentor. So this isn't the end. We definitely have the resources available to address any further questions and keep you moving forward. And so I want to thank everyone for joining us today. And we would be happy to, or would love to see you on a future webinar. And thank you to Eastern Bank and Mike for a great presentation.
Okay, thanks very much.
Thank
Bye.
you. Bye-bye.